Similarly, markets, we understand, especially in China, you have to pay a separate, we have distributors in India and tax authorities are making adjustments. There, in fact, there is a market premium adjustment which needs to be done, which means that if China has offered a market for the products, there has to be a separate premium that needs to be paid to the Chinese entity for generating that market. So each country gives weightages to different aspects. Like if it is a country like US and UK, they give a lot of importance to R&D because those are the jurisdictions where R&D happens. But if they are all developing countries like any country in APAC, whether it's Vietnam, China, India, these countries don't develop so much of R&D, but what they offer is the market. That's why you see lots of litigation happening in China, India around, saying that people are valuable, we are offering you markets, we are offering you ready-made market. Those are the kind of arguments that happen because what was happening till now is that all the residual profit was going to the developed countries because he was the owner of R&D. So India, though it, or China, though it was offering a market, it just got a 4-5% net margin. So that's where, they learned from the various case laws and developments happening overseas, like in US, where one of the entity was offering market to those products. They decided to do a profit split instead of using a resale price or a T&M. So that's when the Indian authorities, the Chinese authorities, the Vietnamese authorities, they all decided that, okay, this is a critical aspect, this is also an intangible, and we should get certain value for it. That's how, the litigation starts because of the fight that happens across jurisdictions. So the tested party ideally should be the entity whose data is easily available to you. In the Indian context, though as per transfer pricing principles, you can take overseas entity as a tested party. You end up, justifying the Indian entity because the transfer pricing officers are very comfortable with the Indian comparables, the Indian databases. So we have this situation where the overseas and in one of the software cases where India is the entrepreneur and the overseas entities are just service providers. We have used the overseas databases to benchmark. So that's how the documentation gets prepared. But each year in litigation, in addition to all those things, in our case it's very good that the Indian entity has profits and very good profits. So they make us search for the Indian comparables which they document, and they want to be sure that the Indian entity is also fine. So though transfer pricing principles may say certain things, based on the jurisdiction certain deviations may be required. So in this situation, we are sure that this entity is profitable. So though our main argument is around the foreign comparables, though he takes the Indian comparables, it's okay. But what was the situation if the Indian entity was into losses? We have kept the cost plus there, we have brought all profits into India, whether he can still make adjustments. So there are so many matters which are in litigation at ITAT level, just on deciding whether, the taking overseas entity as tested party is correct or not. So the kind of adjustments that are happening in those kind of cases even exceeds the profits which the entire group has made. So those kind of analysis would be really helpful here. So concept of tested party is very important. Now coming to any questions on tested party? Now coming to the factors which are going to influence your comparability. You know what your transaction is, you have to justify that transaction. So you have decided, let us assume that India is a tested party, then you have to choose the comparables. Now let us take a situation, say he's a software developer and he's a captive software entity, so you don't have any internal comparables. So you go to the external databases, and within software also, there are so many segments. So which segment does he fall into? Because within that also, each aspect may be different. Like for example, e-learning companies may be highly profitable. Similarly, CAD/CAM companies may be doing good, but a database operator may not get so much of profit. So identifying, rather than keeping a generalistic, comparables, it's better that you try to identify comparables which are close to you. Sometimes comparables can also be internal. For example, you are doing certain technical services. You are doing it for your group company as well as for a third party. There are which are situated overseas. You may have certain per hour rates available which you may want to compare. So you may decide to use a cup method. So accordingly you have selected your comparables. Sometimes you also have to make comparability adjustments. There may be difference between your comparables and between you. And knowing those differences is extremely difficult. You may know what you are doing, but what comparables are doing, there's limitation of what is disclosed in the annual reports. So what are the comparability factors? The property, what is the product? Similarity of product, similarity of service. The functions have to be same. For example, I took the technical services where you're doing technical service to your group company as well as to your third party. But let us assume that for a third party, there are certain differences, say in contractual terms. Your group company makes you payment within 60 days, while a third party takes much longer time to make payment. So your per hour rates may slightly differ on that count. Or maybe there may be situations where your group company gives you substantial business. The third party was just one-off, who is not your regular customer. So you just decide to charge him whatever price and he has given you. So the value and the volume is also very critical. Then the economic circumstances and the business strategies could be important. Like for example, you may decide that you are entering into a new market, and though that entity is taking certain risk, you want to penetrate that market. It's a decision you have taken, whether those kind of business strategies are there or whether that market is well established for your product and you need not give any certain discounts to the overseas entity. So those, whether then the kind of analysis you may have to do is your product, what is the stage at which it is, you have significant market share or not significant market share, again depending on situation to situation. At times we have seen comparables are very difficult, technologies are new, getting perfect comparables is very difficult. There is a constant issue of cherry picking of comparables. Office always wants to select companies with high margins. But then after so many years of litigation, especially in software, IT, ITS industry, more or less there's a precedent available as to, these comparables may get rejected. So that kind of analysis, when you are creating documents, whatever is your industry, whether there are case laws available on certain comparables, that kind of analysis would be really helpful. Losses, again a very difficult situation. How do you justify the losses? Customs valuation, whether what is the things which are happening in customs, whether your imports have been accepted there, what kind of data you had given to the customs authorities. At times we have seen that in fact our transfer pricing reports get submitted to the custom authorities, for clearance of those goods. So your report, you have to be sure whether he's going to go and give to some other authorities. If yes, then most of the times it could happen. Like it could get into the hands of custom authorities, it could get into the hands of overseas entities, overseas tax authorities. So what you write in your study report is very critical. Like for example, your client will make a 30-40% margin. Your comparables are just 20-25%. So from an India perspective, it may be arm's length, but if it gets into the hand of a US authority, it's sure that some repercussions may be faced by the overseas entity. So again, it depends on what kind of MNC it is, whether there are potential litigations in overseas. But you have to be careful of what you give to the tax authorities. What are the factors you will consider in the comparables? Whether the comparables are having high related party transactions, we have various case laws on that. Whether they are making abnormal high profits or losses. So the case laws say that just because it is high profit making company, just don't reject it. You have to study that further to understand why it is making higher profits, whether they have certain high intangibles which is leading to those profits or some other factors. Some entities undergo business restructuring, there are some mergers, amalgamations, suddenly their profits have shot up because of that. Some companies are showing some exponential growth, so they may no longer be comparable to you. So these are certain factors that you may keep in your mind to decide about comparables. In selecting comparables, it's always better that you try to keep your, there's no hard and fast rule as to how many number of comparables you may have. But it's always better that you should have at least 5 comparables or more, because it gives a better picture of the industry rather than just selecting 2-3 comparables. Because if some of the comparables get rejected, you are left with no comparables at all. So try to study the industry and broad base to whatever extent the comparability. So important issues in comparability is how do you benchmark startup companies or loss-making companies. Here you cannot just do a T&M, select comparables, because you have to see whether the comparables are also startup companies, make certain adjustments, have some other additional documents to justify your losses or to justify when you will turn around. Some of the companies maybe, your comparables may be diversified. So which each company reports its own segment. So which segment you want to select as comparables. And when the segments are prepared, even in the segmental analysis, there's a lot of unallocated cost. So you need to allocate those costs correctly to identify the margin of that segment. In India, at least we have segmentation, but when we do overseas analysis, we see that diversified companies tend to get rejected because there the databases don't support so much of data about segments and all that. So in fact, Indian databases are more robust, Indian reporting is more robust, and annual reports give a lot of information. There may be certain events which have happened in that company, like suddenly there may be certain legal suits that have been filed against the company because of which suddenly their business has stopped, or maybe there's some labor unrest which is happening due to which there are losses. So if you have selected that company, the tax authorities may reject it because of those kind of situations. So there are the filters which all of us by now know. There are various filters which we give on databases about selection from that industry code, rejecting companies who do not have adequate data, who undertake R&D, huge assets. So those are quantitative filters. So once quantitative filters are applied and you have a particular set, you need to analyze that further qualitatively. Then you will go through the annual reports, study them in detail and identify your comparables. So as far as possible, try to depend on the annual report for that particular year, because internet, though you have relied on the internet, by the time the assessment comes, the internet of the company gets updated. So there may be some other activity. So as far as possible, try to rely on the annual report. I think these are all factors we have discussed. So very quickly, I have 5 minutes. So very quickly, as I said, documentation would all depend on certain situations. And depending on situation, you may need all these parameters. At times, a segmented PNL may not be important if you're not doing segmentation, if you're just doing an entity level analysis. Similarly, if you're in a captive setup where it is just a cost plus 15, a global policy may not be helpful. But on the contrary, a global policy may be helpful in a royalty transaction because the officer may want to know whether there's a consistency in policy. We have seen certain situations where, some groups only charged the royalty, and that royalty was linked to profits, not even sales. So whichever company was more profitable was getting charged more, which means the profitable entity was subsidizing the subsidiaries which were not making that great profits. So if those kind of policies exist, and if you come across, you can always give a suggestion to, improve, because otherwise there's no consistency in the treatment of subsidiaries across the globe. Internet downloads agreements could be helpful. All these letters, correspondence could be important where, they are giving you certain technical services and you have to prove what are the benefits that you have received, whether those services were actually rendered. So it all depends on situation to situation. Otherwise, if those kind of transactions don't exist, you may not even require these kind of documents. Try to maintain all the published accounts. Try to rely on the annual reports of the company and try to maintain those as a record. If you are using certain information from the exchange, that for example you are importing certain commodity and you have relied on the prices quoted in the exchange, what kind of circulars those exchanges have, whether those documents can be maintained. So very quickly to summarize, these are the key aspects of a functional analysis. Documenting the FAR is important. It helps you to select the test party correctly choose comparables, and determine whether you are arm's length or not. Thank you.
Thank you, Vaishali, for an excellent presentation. I think we have time for one or two questions. So if anyone has any questions, you can please ask this now. If no one has, then I can ask one question. See, in case of companies which enter into India, they take a lot of time to really start generating profits. And we have cases documented of Pepsi and Coca-Cola. They have made losses for many years. But for several other industries which are smaller or unlisted, how do we establish that we are making losses because we are new in India?
I'll give you a live case. Of course, it is very fact specific, but you have to look into the facts of the case. We have this company which is into industry related to petrol and diesel products, and they are manufacturing something and selling that. They have been in India at the entity level in losses for almost 14 years, and doing their transfer pricing for past so many years. Almost 14 years they are into losses. And after 14 years, we see some minor profits at entity level coming. So they have host of transactions. They are buying raw materials, they are manufacturing and selling the products, they are doing certain warranty for third parties, they are doing certain software projects also. Now, if you have to just look at the case, it's till 14 years they haven't been able to establish themselves and they have made losses. So, how do you document this? So we have to get into the details of the facts of this case. So what we realized is that they have two activities. They are doing business independently also, they are doing certain manufacturing for the group company also. Now they are selling this product which is dispensing petrol at various petrol stations, and we realized that Even Reliance, they had set up their petrol pumps across India, and because the way the petrol prices were going up, down, it became unfeasible. They closed down all their operations. So we tried to understand who were their comparables. Their comparables, they had one was Reliance, which shut down. They had one more very big, one of the big entities in India who had these operations. They tried to, and without a JV, they tried to set up this operation, but they could never set up, so that business was sold. So we documented that. There was only one entity in India which was doing slightly well, because in terms of turnover it was doing slightly well, but again at the net level there was a loss. So we tried to document all this about competition and about the industry. Then in his case, we realized that he was trying to, most of their customers are government companies to whom, like for example BPCL and all those companies are there. And those, you have to be very, and it's a bid process, and you have to be very competitive in bidding. And because of that, they were constantly, undercutting prices, and we had those cost sheets. Of course, the data is too internal. So those cost sheets demonstrated that we were not even able to recover the cost of production, because it's all a volume game. You need to have certain parameters, number of years of operation in India to qualify to bid, or maybe you need certain amount of turnover. So they were always trying to achieve turnover at the cost of profits. So those kind of documentations we were able to collate. And we realized that all the losses was only happening because of all this, and it had nothing to do with the raw materials that were going into that manufacturing process. So when we were able to give these kind of documents to the officer, and the assessment was done by the most strict officer, and he looked into all these aspects, and he was convinced that it was not the raw materials that were leading to losses, because making losses for 10-14 years, even not only the officer, transfer pricing officer, but even the consultant is going to be worried to sign the Form 3CA. And when you dig into all these factors, you'll realize that the losses are not purely because of group company transactions. There may be so many business factors. So in these kind of situations, saying that this is the amount of adjustment should happen or that is completely wrong. It's very subjective. You have to get these kind of documents. It may not be a part of your documentation, but you may have these documents and present it to the officer when these kind of questions come up. So it would be very fact specific. Sometimes it may indicate that those losses are purely because you are not selling correctly to the group company. Let us assume this case where you are manufacturing and selling only the product to your group company, and the cost sheets indicate that you are not even recovering the cost of production. Then of course the officer has all the right to make adjustment if you are not selling to a third party mode. So it would be very fact specific.
So we need to document well and establish really, and therefore you will agree that we had a very good speaker. Right? She has been able to convince the department for 14 years. Yeah, I think friends, may I request Namrata to propose a well-deserved vote of thanks, and any questions, she will be there with us, we can ask during lunchtime.
Friends, you would all agree that the